Welcome back to the Funding Blueprint, the podcast where we explore the journeys and insights of innovators and entrepreneurs in the startup ecosystem. I'm your host, Abraham, and today we have a special guest whose expertise spans across finance, accounting, and staffing solutions. Our guest today is Dave Olson, the founder and CEO of Nimble and Nimble Staffing. With a background in public accounting and a decade-long experience as a contract CFO for a venture capital fund and various startups, Dave has honed a unique approach to financial management and staffing. In 2018, Dave leveraged his experience to create a comprehensive system for providing full accounting, finance, and tax services through a team based in the Philippines. This innovative approach led to the hiring of his first US employee and the rapid scaling of his operations. Additionally, Dave launched Nimble Staffing and separate entity dedicated to placing bookkeeping and administrative professionals from the Philippines with North American companies. Today, Nimble and Nimble Staffing have grown to a remote team of over 100 professionals located across the US, Canada, and the Philippines, all while being bootstrapped. Dave, a CPA in both California and Canada, brings a wealth of knowledge and experience to our conversation. Originally from Alberta, Canada, Dave now resides near Salt Lake City, Utah, with his wife and 3 children. When he's not driving his business forward, he enjoys the natural beauty of Utah's mountains through biking, hiking, and snowboarding. Join us as we dive into Dave's entrepreneurial journey, his innovative business models, and the lessons he's learned along the way. Let's welcome Dave Olson to the show.
Thank you. It's great to be here.
Of course, pleasure's all ours. So I want to dive in. The early days of a startup are a whirlwind of passion, innovation, and the relentless pursuit of growth. But amidst the excitement, financial missteps can derail even the most promising ventures. Many founders, particularly those with non-financial backgrounds, find themselves grappling with the complexities of managing a business's financial health. So let's talk about some common financial pitfalls early-stage founders encounter. Understanding these mistakes and the strategies to avoid them can be the difference between a startup that thrives and one that stumbles. So Dave, can you elaborate more on some of the most frequent financial blunders founders make in the early stages? And more importantly, how can they be avoided through proactive planning and financial literacy?
Yeah, I'll first set it up to say that it's really important for founders to find a good balance between addressing the financial function and understanding it, and also not kind of overdoing the administrative side. Sometimes it can be a distraction to, get everything perfectly set up in the background and not even get to the point of creating a great product or a great service because you're, worried about all the details that go into running the business. So first of all, if you don't have a great product and a great service, then there's no accounting to do. There's no finance to handle. And so first, get a great product, great service, but the financial function is important part to think about along the way at the appropriate levels. So at the basic stage, it's really simple to set up a business bank account and a business credit card and to keep everything separate in the business. It's not going to take a lot of time to get this done, and that'll save a whole lot of headaches for later. And even if that's all you do to get started, you have everything separated out, it's really easy to account for it and do the tax return and that when everything's separated. But when you have it mingled with personal accounts and all kinds of different places, it's hard to put that picture together. So first step, get a separate business bank account and a business credit card. The second thing is to be aware of all tax filing implications. There's income tax, there's sales tax, there's local property tax, depending on the nature of the business. Just be aware of those. And a lot of those from the beginning can just be a quick conversation with a friend that's familiar with these things. It could be just a little bit of time with a tax professional. It could be even just doing some Google searches and being familiar with what's required. Some of the common ones to be aware of is if you're a partnership or a sole proprietorship or an S Corp, a lot of times the tax return is due by March 15th or April 15th after the end of the year. And so you don't have to actually file it and be done, but you have to file an extension or else you can get pretty hefty penalties. So just being aware of that, just filing a quick extension or asking someone to file an extension for you is a great way to stay out of trouble. And then that gives you another 6 months to actually do the filing. And there's things like Delaware filings or state filings, depending on the state you're in. Sales tax, especially if you have a physical product, but even if you have a service or a SaaS product, sometimes sales tax applies. So you want to understand as soon as you start selling, bringing in revenue, what are the sales tax implications. And along with sales tax too, it's important to understand it's called nexus. And if you're an e-commerce seller or if you do business in more than one state, it's important to understand, even if you don't have a presence, like employees or an office in a state, you may still be required to collect and remit sales tax if you have a certain level of sales. So usually it's not a problem if you're just getting started, but you start selling, 10, 50, $100,000 in state, or a whole high volume of units in a state, you want to make sure you understand these implications. Next one is to be careful about personal debt. A lot of founders get really excited about an idea and they want to go all in. They want to rack up credit cards or mortgage their house or whatever that could be. And that's great to show passion, and the times where those situations pay off really make good stories. But there's also a lot of cases where it doesn't pay off and you're left with no business and a whole lot of debt to take care of. And so just balancing that excitement with being responsible. And the last thing I know we'll talk more about is not understanding the difference between cash flow and profit. There's one thing to see cash in your bank account. Maybe you have a lot of upfront payments, say annual payments for software. But then you've got a whole another year of expenses to use to pay with that money. So understand that just because you have cash in the bank, doesn't mean that you have a lot of money to cover expenses. So just a few common financial mistakes for founders.
Sound advice. I mean, the language of finance can feel like a foreign tongue to many startup founders. Numbers and spreadsheets can be intimidating. I know that from experience, especially when the focus is on building a groundbreaking product or service. But financial statements are like a roadmap for your business, revealing its health and guiding future decisions. Let's break down the basics. Many founders are unfamiliar with the key components of financial statements, particularly the balance sheet and income statement. Can you walk us through these essential documents, explaining what information they provide and how they work together to offer valuable insights into a company's financial well-being?
Yeah, so the profit and loss tells you in a certain period, how did your business do? How much revenue did you bring in, and what were the expenses that you outlaid to earn that revenue? So that's the simple bullet point, cliff notes of what a profit and loss is. I mentioned earlier the difference between profit and cash flow. And so bringing in, say, an annual revenue for a software product, it all hits in 1 month, but you're paying expenses for that over the next 12 months. So can be a more complex concept in financial statements, is the idea of recognizing revenue and recognizing expenses. The accurate profit and loss matches up your revenue in a certain period with the expenses for that period. And so if you're looking at an annual financial statement, that's pretty straightforward. You have all your annual for the year and your expenses for the year, and you see your bottom line. Monthly can be a little more nuanced. When you say take an annual payment, you want to spread that payment over the 12 months to really see what your monthly revenue is. And then you can match that against your expenses, your payroll and your server costs, or whatever your expenses may be. But yeah, the short answer is essentially the money you brought in a period, the money that went out for expenses, and it gives you your profit. Does that cover profit and loss?
Yeah, no, it does. Wonderfully. Fast forwarding and kind of diving deeper into the common misconception of cash flow and profit being the same thing. The world of finance loves throwing around terms that sound interchangeable, but can have vastly different meanings for business. Cash flow and profit are prime examples of that. Many founders mistakenly believe they're the same thing, but understanding the distinction is vital for making sound financial decisions. So let's kind of delve deeper and let's really unpack the difference between cash flow and profit. So can you provide on this concept and elaborate more on this concept by perhaps utilizing some real world examples from different industries to illustrate the distinction?
Yeah, this is really where understanding the balance sheet is really helpful, because when you say have an expense on the profit and loss, it's for that period. So you pay rent for a certain month, that's an expense for that period. But what if you buy a bunch of servers or you buy inventory? That doesn't go on your profit and loss as an expense, but it is cash that goes out. So I think let's start with the balance sheet, because it's helpful to understand that a balance sheet shows you at any point in time, what do you own and what do you owe, and what's the difference? So what you own is your assets, and that could be the cash in the bank. That could be inventory you've purchased. It could be servers that you purchased. Um, so those are common examples of what you own, what you own. What you owe is the liabilities. So it could be a credit card balance if you have a business credit card. It could be any loans you've taken. It could be payables. You buy a service or a product and you have some time to pay. Your payable shows you what you owe. So it's really important to understand that. I guess the last one is the equity. The difference between assets minus liabilities is your equity. And so it's really important to understand that when you buy something, you put something on your what you own. Say you transfer money from your bank account to buy inventory. That's just on your balance sheet and it shows what you own. And that's cash outlay, but it doesn't show up in your P&L until you actually sell the product. And so there could be a mismatch. You could, buy a bunch of inventory before you actually have profit to pay for it. So you need the cash to pay for it before you sell it. On the flip side, which I think can be even more dangerous, is I've used the example of taking a year payment for a software product upfront. You take that payment upfront and you think you have cash. Well, you do have cash in the bank, but it's not profit yet because you still have expenses. You have server costs, you have customer service, payroll, and anything that you would need to deliver that software over the next year. You still have that expense. So you need to understand the difference between cash in the bank and what the actual profit is. And it can be a real pitfall. You can have companies that look profitable on paper, but are burning cash because there's a lot of capital expenditures. On the flip side, you could have a company losing money, but have a good cash flow because you keep having new annual contracts come in. And it's just really important to know the difference. Or eventually you'll pay the piper. If you have really good cash flow because you're taking these annual contracts, and then all of a sudden that slows down or stops, then you've still got expenses that you're committed to. And so, yeah, really important. It's a pitfall for a lot of businesses that actually can kill a business if you don't understand that difference.
For sure. And I mean, you and I can agree that, the lifeblood of any startup isn't just a great product or service. Let's be realistic. It's really cold, hard cash. I mean, revenue might look good on paper, but if cash isn't flowing in and out strategically, even the most promising venture can really run aground. So that's where cash flow forecasting comes in. It's like, in essence, to my understanding, it's like a crystal ball for your finances, helping you predict future needs and avoid potential pitfalls. So cash flow forecasting is actually a crucial skill for any entrepreneur. Can you share some practical strategies founders can use to project their cash flow? And more importantly, how can they really factor in those sometimes unforeseen tax liabilities to ensure that their forecasts are as accurate as possible?
Yeah, so I just want to first reiterate what you said of the importance of gold hard cash. There are probably as many successful businesses, and successful in terms of revenue growth and scaling, that have gone out of business because they've run out of cash, as there are those who are just a bad product or service. That fast growth without managing cash can be the death of a business. So super important to understand your cash position. And it starts with what we just talked about, is understanding the difference between cash flow and profit. And as you understand that difference, then it's using some way to project and have an idea of what cash you have coming in and what cash is going to be going out over time, and to make sure you stay ahead of that cash flow. You mentioned the tax, and can be a huge pitfall because especially those founders may go from being a W-2 employee where you have tax withheld from your paycheck and you don't really have to think much about it. You file your tax return at the end of the year, and you may get a small refund, or you may have to pay a little bit, but really tax isn't a big factor. But business is a whole lot different. You are taxed on the profit of your business, and you are responsible as a business owner to pay that tax throughout the year. There's estimated tax payments that have to be paid each quarter, and then at the end of the year, you do a return and kind of true up exactly how much you owe. And it can be, it's hard to know at the beginning, what do I set aside for taxes? So a good rule of thumb is, if you have an idea of what your profit is, to set aside about 25% of your cash. Put that in a separate account. Don't touch it until it's ready to go to the IRS. Set about 25% aside. And this is if your profit, not of your revenue, 25% of your profit. If you can just estimate that as you go, set that aside, and then you won't be stuck with a tax bill that you're not able to pay. And then with that remaining 75%, again, understand where the money's coming from and when, and the timing, and what money needs to go out and the timing. And it can be super simple to start with, especially. It can be um, a spreadsheet. Just have a simple, say, put the months as, even the weeks, I should say. Weeks as the header, so a common time frame for that is a 13-week cash flow projection. So put 13 weeks out and list across the top the weeks, on the left the money you expect to come in each week and the money that's going out each week, and tally that up to see where you're going. And you can zoom out too and then look at the bigger picture of monthly or even yearly of what you might expect for cash flow. And then you have a pretty good idea. So you don't necessarily, especially in the beginning, need a super expensive finance professional to do a cash flow projection. Simple spreadsheet, or even write on a piece of paper. Write those weeks on a piece of paper and keep track of the money. Obviously, that can get a lot more sophisticated as the business grows, but that's a good starting point, just to be aware of where the cash is coming from, where it's going.
Agreed. I think it's important. I mean, I speak to many different types of founders, and they put a strong emphasis around getting, an already established accounting firm, or obviously accounting solutions that can kind of help them manage their finances and kind of manage and document all their expenses. But in reality, it just really comes down to taking a piece of paper and a pen, like you said correctly, at least in the beginning stages. When you have funding, when you're generating revenue, and you have the means of supporting that, then you invest into that. But I think from a very early perspective, there isn't much that needs to be done from a documentation perspective. I mean, having something as simple as a paper and a pen will really suffice. So I agree with you on that. I mean, as a founder myself, we have to, and I can speak for all the founders, we have to wear a lot of hats. We juggle product development, marketing, and a multitude of other different types of crucial tasks. But the financial side of the business can be particularly daunting, especially for those without a strong, accounting background. The good news is founders don't actually have to go through it alone. There's many resources out there that are available to help founders with bookkeeping, financial modeling, tax preparation, and other financial aspects of running a startup. But the key question is, when does it actually make sense to outsource these tasks? And what resources are out there to choose from? Can you elaborate more on the different types of help available and the factors founders should consider when deciding whether to handle these tasks themselves or bring in an external expertise?
Yeah, so I can give you different milestones to think about for that. When you're just getting started, going back to what we've already talked about, set up a separate business bank account, business credit card, keep all of your business transactions separate. And then having an idea of your cash flow, whether it be pen and paper or a spreadsheet, that can get you fairly far, especially in your first year. And if you're comfortable with that and you feel like you have a good pulse on your business, then keep that simple and focus on your great product and service and really getting traction. The first milestone is really the first year end. Say you start your business in March, you get to December, and you're going to have to start thinking about tax filings. And that's where you definitely should get a professional involved. You don't want to do it yourself with your own tax returns. It doesn't have to be expensive in the first year, but you need somebody involved. And companies like Nimble, my company, we do outsourced tax and accounting and finance. We do all this for companies, and we can just do a consultation early in the process. So you're coming towards the end of the year and you want to know, given your circumstances, what do you need to be aware of? And we can do a quick call and assess where are you at. And it could be just that you need a tax return, and we can put you on a small subscription. We have subscription-based tax services where usually for between, say, $80 to $100 a month, we can take care of all your tax needs for the year. And if you have really simple bookkeeping just in your bank account or whatever that might look like, we can use that as the basis for preparing the tax return. And then as you get more sophisticated, and as you get more transactions, and this is taking more of your time than you think is helpful for, you could take a few hours doing your bookkeeping and keeping track of your cash flow, or you could use that time building your product. So when you start seeing that time value trade-off where you feel like you can get more traction in your business, then it's time to start thinking about paying more for a professional. So to give you an idea, and there's lots of services similar to ours out there, but we can usually get a full service started for around $400 or $500 a month. And that's handling your bookkeeping, advising you on payroll, tax filings, just to make sure you've got everything in order. And so if you start thinking of, is $400, $500 worth of your time. Is that worth the time and brain power that you're spending on it? Or is it better just to get it off your plate and stop worrying about it? And then it grows from there. Instead of most businesses can get very far without hiring a single full-time accounting, finance, tax person. Most of our clients are from the startup stage up to 10 million is our typical sweet spot. And 10 million's a long ways out there for a lot of founders. And we even can handle companies 10, 20, we even had a $100 million company. So a lot of founders don't realize that there's a solution out there where an outsourced team can become your fractional team and handle the accounting, tax, finance. You don't need to spend your expertise and your brain power on hiring an accounting person, managing that team, all that. You can just let a team handle it.
That's a phenomenal idea, and I think it should be encouraged for individuals to actually look upon that and take action. So I agree with you on that. The world of startup funding can feel like its own secret language, filled with terms like equity investors and cap tables, that leaves founders scratching their heads. But understanding these concepts is vital for securing the financial resources needed to propel their business and their venture forward. Equity investors are like teammates in the startup game. They provide capital in exchange for a piece of the pie. Let's kind of break down the world of equity investors and cap tables. Can you explain how equity investors function, what their expectations typically are, and how their involvement actually impacts a company's ownership structure?
Yeah, and I think it's important to understand the kind of the bigger funding landscape, and then we could talk about how does equity fit in specifically. Like we talked about, um, businesses have cash flow needs. You need to pay people, pay for products, pay for services to get your business going, and that takes cash. And ideally, you get to the point where the business is generating cash fast enough that you can pay those expenses, and you don't need a lot of outside funding. But it's important to get really clear on where you intend for your business to go. Is this a lifestyle business where you want to maintain control and you're okay with slow growth? In that case, you want to not take on too much or any debt or any equity investors. You just want to fund it yourself, maybe build up enough savings or runway where you can fund it until it gets to the point where it's profitable or cash flow positive. But if your intention is to really grow and scale and to get a lot of funding behind you to really take off, and it could be based on the nature of the industry where it requires a lot of cash up front to even get any kind of traction. That's where having equity investors could be a useful path. So definition of equity investors is basically they own a piece of your company. So when you start a company, if it's just you own 100%. But as you bring in other owners, you put a valuation on the company, or they put a valuation. And early on, where there's maybe not much revenue or much traction, it's a pretty arbitrary number. But they'll look at the industry, they'll look at your history and background, they'll look at the opportunity, and investors will kind of have a sense for what are they willing to value a company at in the early stages. And let's just call it $1 million to keep it. It doesn't mean that you can go out tomorrow and sell it for $1 million. It just means this gives a basis for dividing up ownership. So if an investor values a company at $1 million and they may give you $100,000 for 10% of the company, and then they own 10% and they're entitled to 10% of the profit or 10% of the proceeds of a sale, whatever that might look like, and even 10% vote and control of the company. As you get up into the higher numbers and higher dollar values, there's a lot of conditions that sophisticated investors will place on that. For example, a venture capital fund might give you $200,000 for 20% of your company, but there's going to be a lot of conditions on that. It's like there's a really important term that every founder should be aware of, and that's called a liquidity preference. So that means that you have $1 million company, they own 200,000 of it. Before you as an owner see a dime, they're going to get their $200,000 back. And then you can take what's above that if you're the only other owner. So really important to understand the terms that go into investments. And then especially the control. If you have an investor come in and want to buy more than 50%, they're essentially buying control of the company. And so it's just important to understand those implications. And then you mentioned a cap table. That's an important term to understand. It's basically a schedule, and it can be as simple as a spreadsheet or even a piece of paper, just showing who owns the company. That cap table is simple at the beginning. You own 100%, or you and a partner own 50-50, or whatever that might look like. And then as you bring in investment, you divide up that ownership, and that cap table becomes a really important tracker of who owns what. It can also track stock options. If you give out stock options to employees or things like that, it'll track who has options to buy equity. So there's a lot of details and complexity to go into equity investing, but those are some of the basics to understand as you start exploring the path of equity investment.
That's awesome. That's awesome. Thank you so much, really, for sharing all of your incredible insights. I mean, as we conclude today's episode, we wanted to extend our sincere gratitude to our guest, Dave Olson, for sharing his valuable insights about the financial instruments and funding options essential for navigating the startup journey. If you're enjoyed this episode, be sure to subscribe to our podcast for more thought-provoking conversations with industry leaders like Dave. For our listeners interested in learning more about Dave and Nimble, we'll have their links and their website and their social media in the show notes. Thanks for tuning in, and until next time.